All right, let's talk about a market theme that we've been seeing. It has to do with short interest. In fact, that short interest on the New York Stock Exchange climbing to the highest this month in more than 75 years. So we want to take a closer look right now with Joseph Parnes. He's president of Technomart Investment Advisors. He says traders often lose money by shorting stocks too soon. And Joseph is joining us from Baltimore this morning. Good morning, Joseph.
Good morning. Thank you.
Let's talk about some specific stocks, because an interesting thing that we noticed here at Bloomberg is Radio Shack and Amazon very heavily shorted, but top performers so far this year in the S&P 500. What does that tell us?
Well, the timing for the short selling of this particular two stocks that you just indicated are not correct. These two companies, now let's just zero in on Radio Shack, for example, after restructuring, if you look back into the charts, you'll see accumulations, a turnaround sometimes at the beginning of the year with a tremendous volume behind it, and kept on going. They both trading over the 200 days and 50 days averages, and they have not ever violated those, and they have maintained that uptrend with going perhaps gaps formation beyond it. Normally you can see these things. The reason for those gaps is the shorts covered by the short sellers who probably were premature, and therefore there is no time for that kind of a stock to short. Also, you have to remember these stocks are going back up because the earnings prospects are improving, even though that the PE at this time may be in the 40s or perhaps hundreds for Amazon.com. However, the expected or the forward-looking earnings, the PE ratio will be retracting dramatically. That's what shows into the price of the stock. You don't want to short a stock that is going up. Rather, you have to select the stocks that are going down. First, from the fundamental reasons.
Actually, Joseph, let me jump in there so we can break it down a little bit. Tell us a little bit about your strategy, because I know in the money that you manage, you do have some shorts, and here obviously we're talking about bets that a stock is going to decline. So how do you approach it? Just real briefly, what's your strategy?
Okay. Exactly. Normally, you want to see a stock's deterioration of the fundamental first. There is some indications that the institutionals or the money flow is receding, that is, exiting by the institutions. Normally, that happens when there's a tremendous plunge at one time while it's ascending. That plunge with a heavy volume, you want to wait perhaps 2-3 sessions to see if there is a rebound. On the rebound, you want to make investigations, or rather a study, to see again if there is accumulations of stocks, or perhaps it's just a V-shaped rebound, or possibility of staying in coming sessions that the shorts probably will be coming back again into it. Then you want to short on the way down, and that's really the indications that the stocks is not rebounding. Rather, the tepid rebound will follow with a further sell-off, and the institutions will follow to sell more into it.
Now, what about the two that we mentioned? Because I believe among between the two stocks, Amazon and Radio Shack, you have looked at Radio Shack and considered the short possibilities.
Well, you want to short if there is, again, no stocks can sustain, or no companies rather can sustain continuous earnings and that tremendous growth that the Radio Shack in this case is coming out from. Definitely the time is not right. It could be perhaps another quarter or maybe 2 more quarters from now. You want to see that that trend slows down, that the institutions and the money managers, that they have accumulated stocks, they have satisfied their objectives and they are exiting. Now that's the key. You don't know really when the time is. Certainly, this is not a time to short.
One thing that's interesting in terms of the trend with the short interest rising, it's coming as buy recommendations from analysts slipping below holds for the first time in at least 10 years. So basically, analysts much more cautious. What does that tell us? I mean, how important is that trend?
Well, normally when you get upgrades, or even downgrades for that matter, you will see fluctuations in the marketplace of that particular stocks. Definitely articles written up in financial magazines will affect a stock to go up or to go down depending on the nature of the positive or negative comments. You really do not want to use those kind of the hype as a means to short. Again, I emphasize very much, you have to have some sort of a discipline to maintain short position, very much similar that you do with the long positions. For example, if the stocks is going up because of the other hypes or perhaps good earnings expectancy, and there is a gap up, chances are that the stock will have some follow through to go up as well in sessions to come. The same thing is true on the shorts. The difference is in the shorts, because of the emotionalism that has been created and the perception that is given to the traders, the drop is much more fantastic or much more fundamental.
Joseph, thanks so much for explaining your strategy to us. Great having you with us today.
Thank you very much.
All right, we will take a break. We're back with your World National News straight ahead.